Good morning and welcome this morning to Trader Talks in today's market. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am joined by my good friend Jeffrey Abelos today, who we're going to meet in just a minute. I'm also joined by another good friend, Connie Hill, out in the chat. She's going to be helping out to answer questions. Now, Connie is a 20-plus year veteran of the financial markets, and she is there to help answer the questions we might have along the way. I'll tell you what, it has been an interesting week last week, and it's setting itself up to be an interesting week this week. And I think that's always, something fun to say, that it's interesting. Now, whether or not interesting means crazy, whether or not interesting means volatile, whether or not interesting means good or bad, really is determined by your perspective on things. So let's do this. And before we jump in with Jeffrey, let's take a look at a couple of quick housekeeping items as we get started this morning. Remember, everything we talk about simply for illustrative and educational purposes only. It is not a recommendation. It is not any kind of advice. Also, remember that if we talk about options, remember that options are leveraged products. They carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It's a great sandbox to learn in. It's a great place to practice. However, it doesn't do certain things that a live trading account may do. It doesn't allow for the early assignment of short options, doesn't allow for studies in scans. The biggest thing that any trading platform, the biggest limitation is that it doesn't guarantee future success out there in the market. The only thing that does guarantee success, well, is, I don't know, Jeffrey, perhaps practice and application of prudent ideas. And even then, there is uncertainty and risk in the market because past performance is no guarantee of future results. So those are some of the things we're going to be talking about. Let's meet Jeffrey Abelos this morning as we talk a little bit about what we're going to do. Jeffrey, you and I were just together in Scottsdale, Arizona, doing a 2-day technical analysis and option strategies workshop. But it's always a great opportunity to have you here with us on Trader Talks in today's market. So welcome.
Thank you very much, Ben. Thanks for having me. I know that you are in very beautiful Flagstaff, Arizona right now. I was just there after we were together this weekend. I went snowboarding yesterday in Snowball, spring skiing / snowboarding. It was absolutely gorgeous. So I know you're going to be enjoying that wonderful weather. And hello, by the way, to all of the viewers out there. I hope all of you are having a great day as well.
Absolutely. And I'll tell you, great day. I mean, depending on your perspective on the market, market volatility can be a situation that brings opportunity. That's something that I often mention, is the fact that when markets are volatile, that changes things. That changes people's perspectives. It changes the opportunities that exist. And maybe that's the way that we look at the market today, this morning. You know, the general trend of the market has been moving in a particular direction, but trends of sectors have been changing. And so there's always something perhaps where money is rotating into and money is rotating out of. And those are some of the things that we're going to look at here this morning. So why don't you set us up, Jeffrey, with what's gone on over the course of the last week, what's been going on in your world, and also for those who might be brand new to this particular webcast, tell us a little bit about your role as a regional investment strategist.
Sure. Well, I'll start with the latter. So my role is to bridge the financial knowledge gap for our trading and self-directed clients in our local branches. I'm very fortunate to cover the Southern California and Arizona regions. And what I try to do is essentially meet clients where they are and figure out where they need to be. And part of that is just having sit-down conversations and talking about what it is they're looking to do and how it is I can help. As to the former question, what's happening in the markets? Oh my gosh. It seems like every day we have a new piece of information that's coming out that rapidly and dramatically could change the outlook for the markets, not just for the entire year, but for the next 5 to possibly 10 years. So it's really hard to digest what is happening, which is why you're noticing a lot of movements in things like the S&P 500, as well as the VIX. If you take a look at the VIX, that is starting to move upward slowly. Generally, what you'll see as we pull up this chart here is that you're going to have these big kind of spike moments. Whoa, what was that? And the VIX goes way up, but then it comes back down. You notice what's happening here lately is we've almost got this stair step movement that's starting to
Yep.
creep in. Now, I think for a lot of traders out there, Ben, this is a little bit concerning because what it tells a trader is that there could potentially be heightened volatility, which means downward pressure over the longer term on something like the S&P 500. So, Ben, that's right now what's capturing a lot of my attention and a lot of the clients' attention that I'm speaking to out in the branches. What's on your mind, my friend?
Well, I'll tell you what, and I'm glad that you brought that up because you're absolutely right. As opposed to being a very discrete and specific spike in the VIX, which is the volatility index for the S&P 500, which is simply this. It is an average of the implied volatility levels of in the money, at the money, and out of the money options across a 30-day cross section of the SPX. So it reflects institutional and retail traders' willingness to buy or eagerness to buy protective positions. Generally, put buying drives the VIX higher because put buying is used to offset adverse movement in long stock portfolios. But I liked what you said about kind of that correlation or inverse correlation between the VIX and the SPX. So the next chart that I've got here is exactly that. This is the VIX overlaid by the SPX. The purple line is the SPX. We can see as it's been going down. The VIX has been rising and generally grinding higher here, not spiking, as you said, because typically when we see those discrete spikes, those tend to bleed off very quickly. A rise in the VIX like this, a grind higher in the VIX, tends to be a little bit longer lasting and a little bit more persistent. And you can see that correlation level, I've got that down in the lower window here, that correlation is now approaching once again that -1 correlation, which is kind of that direct inverse correlation. So when the VIX goes up, the SPX goes down. And it's kind of a chicken and egg scenario too, because you think about why would the VIX be going up? It's because the SPX has been going down and the institutions have been protecting those positions. But one other thing, Jeffrey, I wanted to talk about while I'm on this VIX grid, and this is one that I look at usually on Friday afternoons in my Market Movers webcast, which is summarizing generally the past week and the look ahead at the next week.
Mm-hmm.
But this is the relationship between VIX and the volatility of VIX. The VVIX is the indicator. So the VVIX is that white line, the VIX is that blue line, and just so in what we're seeing in this recent time frame is really kind of a very close correlation. Now they typically tend to move close to one another, but the VVIX expanded faster than the VIX, which simply says that realized or statistical historical volatility of volatility, the historical volatility of VIX was greater than the VIX index itself. What that suggests is that maybe there was a little bit of a lag, and oftentimes when that happens, you see a pop in volatility, and that's exactly what we're seeing today. And what that suggests is that maybe more of those institutions stepping into volatility products, buying the VIX or buying puts on the SPX to hedge long stock positions. And when you see them doing that kind of en masse and over a longer period of time, that's suggestive potentially of more downside movement. It's not me, it's not my opinion, it's not Jeffrey's opinion. It is what technical analysis and the technical indicators that we're looking at are telling us, right, Jeff?
Yeah, that's a really good call out, Ben. Absolutely. We certainly don't know what everybody is thinking. Ben and I don't have crystal balls. I do like this look back, though, at the historical aspect of the VIX. Now, some people would say, okay, well, I'll just throw something onto a chart like a 200-day simple moving average, see where the VIX is at in relation to that. That's going to be a little bit tough, though, because like we said, it'll spike and then generally come back down, kind of laying flat for most of the time. So it really doesn't have a momentum component to the VIX. So being able to see what's happened historically versus what happens presently can be extremely valuable for a trader or especially for an institution that's looking at what could this mean over the next coming weeks.
Right, and absolutely. And I went back here to the regular chart of the VIX. This is a candlestick chart of the VIX. And a
Mhm.
couple of people making the comment, well, wait, the VIX is at resistance. That means that maybe it's going to have a hard time going higher here. Now, here's one thing to think about. The VIX in and of itself, this product as an index is not a tradable instrument. So this doesn't necessarily behave in that same fashion when we talk about the relationship of resistance levels and support levels. Now, that being said, it oftentimes seeks similar levels. So what we could do, Jeffrey, here in
Mhm.
looking at this really quickly, I'm going to change the symbol in this box to /VX, which is the VIX futures market. Now, I'm using the futures market here in this case to illustrate a point, not as a tradable instrument. We're not talking about trading futures. I do that on Tuesday mornings. But we're talking about this in measuring that VIX in terms of movement. And the futures market in this case is perhaps running into a little bit of a resistance level up in this area. That does not mean, and we're seeing a little bit of ease of movement here this morning above that, although it's coming back a bit. That doesn't mean that just because there's a resistance level that it can't break through that resistance level here at this particular point in the VIX futures. One other thing I wanted to talk about, if we can do this really quickly, and
Sure.
not to get too wonky about this, because I know you and I can do that pretty quickly. We can get pretty wonky and deep into
Yeah.
some of these ideas, but I'm going to go to my product depth here on the charts tab on the Thinkorswim platform. And as I look at product depth, I'm looking at the futures deliverable dates. That's what we look at in terms of futures contracts. And you notice the shape of this particular curve. That means the VIX futures contract price, the spot price, is pretty high right now. But you
Okay.
look forward in time to the next deliverable and the next deliverable after that, and that is lower. This is what's referred to as a contangoed futures curve, meaning the spot price is higher than the forward dated curve.
Yeah.
That would suggest that there is more risk in the near term. There's more attention being paid in the near term than there is forward looking. Normally, VIX is what's referred to as kind of a normalized curve, which is low now but higher in the future, because the future represents uncertainty. Right
Right.
now, there's more uncertainty than there is expected to be in the next couple of months, and that would suggest that we might see that VIX bleed off relatively quickly if some of those uncertain elements change a little bit.
Good call out then. I really like this. This kind of what it reminds me of is an inversion of the yield curve where
Oh,
you have higher
100%.
rates in the near term, lower rates in the
Yeah.
future, which is unusual and sometimes called backwardization. But that's a really good call out because I think what it brings to mind is if certain uncertainty matters, if I could use that expression,
Yeah.
um, if they end up not coming to fruition or they subside, that could very quickly move the VIX back down. That could move that curve back down into a more
Yep.
normalized looking movement. So really good call out, Ben. This is a great learning for all of us today.
Hey, speaking of learning, Jeffrey, I wanted to take
Yeah.
this opportunity to do two things. One is remind attendees today to do two things for me: to click on that subscribe button down at the bottom of the page, and that's going to help to connect to the greater Trader Talks webcasts community. It's
Mhm.
at no cost to you. It's a great subscription, and it helps to pop this content and the other great webcasts that we do up to the top of those algorithms. The other thing that I would just maybe suggest is for digging into things like the futures market that we've been talking about or some of these other webcasts. This is a great place to go, which would be schwab.com/coaching. And I know that you're on here on a regular basis, normally with
Yep.
Kevin Horner. The webcasts that I teach, the webcasts that Connie teaches, and a number of our coaches here on that Schwab.com coaching place. But what I also want to do is suggest taking a look at our YouTube channel, which you can link to through Schwab Coaching, but youtube.com/at Trader Talks webcasts. You can also click on the subscribe button here. And if you wanted to learn a little bit more about something like the VIX, you can just type that into the search box here and you can see a phenomenal list of recorded webcasts and upcoming live webcasts that talk about a particular topic. So if you want to dig a little bit deeper into something, this is a great place to go to do that. You can see that a little while ago I talked about gold versus the VIX in my futures class. And so a lot of things going on here, and a great way to kind of reinforce what we've been talking about, what we've been learning about. But Jeffrey, hey, I wanted to take a look at maybe the broader market. There's some things afoot in, for instance, the SPX today. I'm going to pop back over here to my index grid. The SPX gapping below the 200 period simple moving average today. It had been testing it. We didn't get a close below it on Friday. Now today we get a gap down below that level. And this remains to be seen, and this becomes pretty significant, right? Talk to me a little bit, if you wouldn't mind, about the significance of something like the 200 period simple moving average when it comes to a big index like the SPX.
Really great question, Ben. Well, in this instance, what it can become is a self-fulfilling prophecy. The 50 period simple moving average, the 200 period simple moving average are looked at not just by like chartered market technicians like myself, but also by broader market analysts. So you could imagine a fundamental analyst saying, well, I'm looking at the PE, I'm looking at the cash flow and so forth. Then they also bring into the conversation the 200 period simple moving average conversation. Now, right now, just because we have one day where we're below the 200 day doesn't necessarily mean that everything's going to drop out of the bucket, okay? You got to wait for a few closing periods. Some people like to wait 2 or 3 or 4. Some people will say, well, I want to really be sure, so give me 5 or possibly more. But Ben, to your question, what I think a lot of traders are going to be looking out for this week is how do we respond to this drop below the 200-day simple moving average? Do we go ever the more lower and lower and lower in a quickly repeating fashion, which could be very concerning for the near term? Or what others might be looking for is, wait a second, do we sort of magnetize close to that 200 period simple moving average where perhaps we're below it, but just barely below it, leading you to believe folks are hanging on to a positive thought and outlook for the market. So if you're somebody that's saying, well, I am taking a short position, I want to do something that's going to be a dramatic drop, you're going to be hoping that the market continues in succession, downward, 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 moving further away from that 200-day simple moving average. If you're somebody that's on the bull side saying, I'm just not sure, I think any news could be good news and that could really change what's happening in the market, you're hoping for a magnetization of that index onto the 200 period simple moving average, getting really, really close to that throughout the week, and then seeing what happens as we get very focused in on the news, Ben.
Yeah, absolutely. Now, it's interesting that we talk about this because as that 200 period moving average is generally kind of that longer term trend metric, right? So a lot of institutions will use that 200 moving average as kind of an objective measurement to say above the 200, still in an uptrend. Below the 200, not in an uptrend, but not necessarily in a downtrend. And so something like this, a quick move, an excursion, if you will, below that 200 period moving average that then comes back up. And again, as you said, kind of magnetized to that 200. If we see a move quickly below, and then let's say today's candlestick closes above, or tomorrow's candlestick closes above the 200, that can potentially be an algorithmic trigger, right? So for those algorithmic traders and institutions that are looking for a trigger that is a move below the 200 and then a pop back up above, we haven't seen that for a long time here on the S&P 500. I'm going to zoom back out really quickly and go back out in this time frame. Whoop, I zoomed way too far in. I'm going to now zoom back in. So this is a 1-year daily chart. You notice we haven't had a cross below or a close below in the span of this 1 year. So if I change my time frame here and I go back out to, say, for instance, a 2-year time frame, the last time we had that, and I've called it out here on the chart, the last time we had an excursion below the 200 and then back up above was the start of a really strong kind of, not necessarily even in that overbought condition, but a very strong uptrend in the near term. And then it pulled back below the 50, which could be also another algorithmic trigger, and continue to move higher. So not saying that it will, I'm just saying that, you know, if we look back at what can potentially trigger a strong rally. So just so that we think that not all hope is lost here, a move below the 200 and then a move back up above can be a potential trigger for longer term holds to step back in to the SPX broadly.
Mhm.
Doesn't mean that they will, and it doesn't mean that they have to, but we've got a very similar situation to that October 23 scenario where it really triggered kind of this broader move to the upside here. The RSI sitting just above the oversold line, and the S&P 500 moving just below that level.
Hey, Ben, question for you. So as we're looking at the RSI as a viewer out there, and I'm saying, okay, so what do I pull from looking at the S&P 500 going below the 200-day simple moving average and the RSI going below 30? Is there any storyline that can be extrapolated from that experience?
Yeah, absolutely. So the RSI, that relative strength index,
Hmm.
is really two things. One, it's a measurement of extremes. And
Okay.
two, it's a momentum indicator. So when I say it's a measurement of extremes, normally by default, the extreme levels are considered to be this 70 on the upside and 30 on the downside. It can only go to zero, it can only go to 100. And if we see that that momentum push to the downside is getting down near that extreme, that could be an indication that we could see a reversal in that momentum. And in fact, when we start to see price moving lower, but the RSI moving sideways or the RSI starting to move higher, that can be an indication that, again, maybe some of those institutional traders stepping in, starting to push prices higher. It doesn't guarantee that by any means, but it's simply looking at where prices are closing relative to the highs and the lows. It's similar to things like the MACD. It's similar to things like the stochastics indicator in terms of its construction, but it's a simple way to look at momentum. And what we've seen is momentum generally, as these prices in the SPX have been rising really from August to now, that RSI has been staying well below its extreme level. So we weren't seeing a big push, but neither were we seeing a big push to the downside. So the thing that I want to point out here, for all of the doomsayers out there, is that this move to the 200 period moving average without the SPX or the RSI being down into an extreme
Hmm.
doesn't suggest that it was an abject capitulation and everybody was selling off. This is simply kind of a measured move back down to that area, which could be a trigger back to the upside.
Very cool. Okay. Always intriguing to see how different individuals utilize different studies within the Thinkorswim platform to
Yeah.
create that story of, okay, what exactly is happening here based off what I'm seeing? And that was very helpful, Ben. Thank you very much.
Right. Yeah, and that's the thing. I mean, and look, all politics aside, right? I mean, that is a part of the picture, and that's a part of the quote unquote narrative. But at the same time, objectively, we can look at what's going on in the market. We can look at what's going on with prices, and those prices are giving us perspective. And again, we see volatility rising. We talked about volatility. Volatility leads to opportunity because it allows for what's referred to as two-sided trading, right?
Yeah.
Both on options and in equities. When we see volatility increasing, that means that there are traders on both sides of the equation. When there are traders on both sides of the equation, that becomes a more healthy market from the perspective of entries and exits, width of bid-ask spreads, than a market that is one-sided in either direction. And I don't think we are one-sided to the downside here yet in this particular case in the SPX or in individual positions at this point as well. Say one thing, Jeffrey, before we go though, before we move on here, I wanted to point out the fact, and Connie, thank you for posting and pinning that to the top of the page. We've got a feedback survey. When it comes to making these webcast sessions better for you, this is the way that we do it, because this is where we have the opportunity to listen to you. So if you wouldn't mind taking just a moment before the end of this webcast, clicking on that survey link and filling that survey out, letting us know what you think. Connie just reposted it there in the chat. So Jeffrey, what do you say? So I also said that there were a couple of changes afoot here in the SPX. In fact, there are some stocks that are being yanked out of the SPX and some stocks that are being put into the SPX. Perhaps the most notable being FCX, the mining stock, being pulled out, and DoorDash being put into. So we've got an industrial coming out, and we've got a consumer discretionary coming into the SPX, and we see a little bit of change back and forth here. And that's the reflection that this is a living, breathing index, isn't it?
It is, yeah. And there's also a very intriguing statistic. And forgive me, everybody, I don't know it off the top of my head, so I'm going to give you all a little bit of homework. I hope that's okay. But there's research that they've done on what happens when a company is added to the S&P 500 on average over the next year, and what happens to a company that is removed from the S&P 500 on average over the next year. So I'm going to leave it all to you to do your homework on what that says about this. But I know that because you're adding a company like a DoorDash into the S&P 500 and you're removing an FCX from the S&P 500, that means that if I'm running an exchange traded fund, or I have a mutual fund, or I have some sort of strategy that says I have to buy the components of the S&P 500, this is a liquidation and a purchase event. So I'm going to have potentially more buying pressure on DoorDash in the short term and more selling pressure on FCX in the short term. So that's something I think that a lot of traders are going to be keeping an eye on, Ben. But do you think there is a possibility that extends beyond, let's say, a 1 week or a 2 week period for an initial pop or drop on either of these companies?
Yeah, I think you're absolutely right. Well, we're already seeing it here on DoorDash, right? So we saw an initial gap to the upside and then a bit of a sell-off here today. If we were to change this to an intraday chart, we'll change it to a 5-day, 5-minute. We can see what happened here. We got a gap up and then a little bit of a sell-off, and that would suggest it's happened right now, Bill. That has happened, and it is the rebalancing, as Jeffrey talked about, the move into index funds and things like that is going on. So we saw that initial pop to the upside when the announcement was made, and now it's selling off a little bit. And I think that can happen, but you're absolutely right. I mean, that becomes a matter of does the trend stay consistent? So we'll change this back to a 1-year daily chart, and we could probably make the argument that overall long-term trend of DoorDash, which has been up, is still intact here, even though we've seen a couple of price discovery tests a little bit lower than that, but it's still holding that line and is a ways to go from changing that longer-term uptrend. And again, it's always important, I think, to put things in perspective. For those of you that were there in Scottsdale this weekend, we talked a lot about trend and how do we identify trends and how do we put trends into perspective. But the other thing to think about, and I make this metaphor usually in these workshops. If you're on a bus and you want to go north and that bus turns around and starts going south, at some point you got to make a decision about when you're going to get off the bus, right, Jeffrey?
Absolutely. Yeah. And very similarly, I talk about, a lot of us in this space talk about some way of analogizing getting ready for an exit. So if you get into a building, I always tell people, know where the exits are. Before you get into a trade, know when you say enough is enough and you limit your losses. Also when you take profits. I do got to give a shout out though, Ben. I had the best time this weekend getting to listen to you and Ray and Scott talking. So for the viewers out there, if you haven't checked these out, they're complimentary. They not only provide breakfast and lunch, they also provide a wonderfully entertaining experience. I was cracking up the entire time. I was writing things down feverishly as Ben was giving these analogies, like, oh, that's brilliant. I'm going to utilize that one. So if you get the opportunity, Ben's showing you where to go to get to one of these. There's a lot of them throughout the country, and we're expanding them even more. I want to give a shout out to Todd Doyle. Todd Doyle is the gentleman who is putting all of these together and making this happen. Him and his team do a phenomenal job of this. So for those of you in the comment section that have been there and you said, hey, had a great time this weekend, thank you very much for coming. For those of you who haven't been there yet, look forward to this exciting and wonderfully entertaining experience. It was a lot of fun, Ben. Thank you so much.
Oh, thank you. And we had you up on stage for a little bit. And so I'm glad you
Yep.
had an opportunity to talk to people as well. Again, go to schwab.com/coaching and then go to the live events calendar. You're going to see the upcoming event. We're going to be in Chicago for our advanced options workshop coming up in a couple of weeks from now, which is going to be a lot of fun. But hey, we talked about this, and I want to come back to some of those stop ideas here for just a minute. I want to look at two more things, and then I want to look at the sector view here really quickly. I wanted to look at one thing that's perhaps on everybody's attention, and it certainly was when I was fueling up my car in Scottsdale yesterday, and that is crude oil prices. And we've been seeing crude oil prices pushing a little bit lower here. I'm using the futures market for this, again, not as a tradable instrument, but I'm using this as a measure of the market. And crude pushing again below this kind of 67 support level. You can see that that support level has been increasing a little bit, but we're now below it, maybe coming back up and retesting it. And right now, down a little bit, sitting at 66.64 on the crude market. And we take a look at gasoline /RB. Whoops. Let me look at /RB by itself. And gasoline prices on the futures contract there coming back down a little bit as well. So there is some movement. And as Carol points out, we had some movement on the part of OPEC in terms of their production outputs. Now, the other thing that I wanted to see, and you and I talked a little bit about this before we got started this morning, and this is something of importance to anybody that has a mortgage or a credit card or an auto loan or borrows for a business. This is interest rate information. This is the 10-year yield, which means this is the 10-year interest rate, which governs things like mortgages, credit cards, auto loans, business loans, those types of things. And it's pushing lower once again. It's objectively right now 4.22 with some pretty significant levels on this chart, right, Jeffrey?
Yeah. And I'm going to ask you a question too, but really good call out on the support and resistance levels. And I love how they're highlighted nicely for all the viewers there. Question for you, Ben, and this is a good learning experience, I think, for all the viewers out there. I imagine you drew the line towards the top end that we were seeing at the end of last year and the beginning of this year, because that might be a head and shoulders formation.
Yes.
Talk to me a little bit about, because when I look at that and then I look at the chartered market technician books that I had studied all those years, I go, this is a little bit messier. What are the defining characteristics of when a head and shoulders is created versus, maybe this is a little bit too messy? I'm always intrigued to hear that.
So if we were looking at this objectively as kind of the textbook picture head and shoulders pattern, right? We would be maybe looking at something like this, and then this might be the head up here, and then we might have a right-hand shoulder there, and then we have the other component, which is the neckline, right?
Okay.
So this kind of crumbles through that. That's a shorter term head and shoulders pattern. Then we get this quick reversal back, and then it comes back down. So we could probably say that one did maybe what it was supposed to do, but not quite. I mean, when you start to see it being lumpy on one side or the other, it tends to not be as perfect, but price patterns are rarely perfect on the chart. Now, the one that I'm seeing here that maybe has some greater potential significance, and I'll draw this in here, is there's the right-hand shoulder. Here's the head over here, and kind of encompassing that whole range. And then the significance and the reason that I drew this line in here is that represents kind of that resistance on the right-hand side, that 4.35 level, and a pretty clear, pretty textbook level of support or neckline on this pattern right around that 4.12 mark. Now, here's the thing. The general perspective on a head and shoulders pattern is if that we take that distance from the neckline up to the top of the head, and we duplicate it and we put it down to the downside, you can see that puts this, I mean, it puts it down off the bottom of the chart.
A little concerning.
The potential move here. So that would be below that 3.6 level, back down into perhaps the high 2 handle. And that could be a significant move. Now, there's no guarantee that it's going to do that, but, there we go, right?
But that 4.12 coming up off of it. So let's say we continue up a little bit higher, or maybe we start to go down a little bit lower. That 4.12-ish kind of zone neckline is what a lot of traders might be looking at
Right.
for, hey, let's see if the 10-year continues to go even further down. Really good insights here, Ben. Thank you very much.
So absolutely. So I also said that I wanted to take a look at some sector stuff, right?
Yeah,
Because
let's do that.
there's, again, there's some mythology, and there's even some mythology coming out in the chat. And I'm going to say that it is absolutely purely mythology. That wow, everything in the U.S. market is getting sold off, and that is absolutely positively not the case. Anytime you see rotation, you're going to see some areas of strength and you're going to see some areas of weakness. So I'm going to bring up our SPX sector index grid, and we'll take a look at some of those areas. This will take just a moment to populate here. But what I've got on here is a 1-year daily chart of all of the major sectors of the S&P 500. And what you can see is that there is a rotation. There's a definite rotation going on. There has been a rotation out of energy. There's been a rotation out of materials, which is driven by largely energy prices. There's a little bit of a rotation out of industrials. There's a bit of a rotation in the short term out of consumer discretionary. But there's a rotation into staples. That is a defensive move. There's a rotation into healthcare. You can see that 50-period moving average turning back up. That's a rotation into strength. Financials have been moving significantly higher. We can see a stronger move to the upside in financials. Information technology, communication services, the tech sectors, if you will, those have been rotating a little bit lower. But utilities, which are interest rate sensitive, as we see interest rates coming down, utilities, which are interest rate sensitive because they borrow money for infrastructure, we start to see them turning back up. Real estate, sensitive to interest rates. Interest rates coming down, real estate's turning back up. And the overall SPX still, with this test around the 200-period moving average, we can say, oh, we've got a short-term downtrend, but the long-term trend on the SPX is still up.
Yeah, so as we're looking at this, Ben, so very clear that we are seeing in a lot of people's eyes a defensive rotation. I'm going away from my offensive sectors, the information technology, the consumer discretionary, the communication services, into the more defensive, call it financials, call it healthcare, and so forth. A question for you, though, is as somebody that's trading these markets, would I be inclined, or could somebody be inclined to say, okay, well, I'm going to go to growth in the defensive area, or would they be more inclined to say, I'm going to go with value in the defensive area? Any thoughts on that?
That very well could be the difference here, right? And one of the reasons why some traders think about rotating into defensive is the idea that it's not a growth sector typically. Right?
Yeah.
It's a sector that represents this quote unquote value, right? Intrinsic value, book value, earnings value, growth in those areas, right? So think about it from that perspective, right? There is this idea that value represents a company that has been punished by the market price-wise, but it still has good intrinsic value. It's still a good company, and that eventually, because it's been driven down by the market or punished by the market, or maybe more appropriately here, ignored by the market in deference to growth, that at some point the market's going to come back and say, oh, here's that diamond in the rough that's got great value. I'm going to buy that. I'm going to rotate that, and I'm going to bring that price back up. And that's kind of the perspective. I don't know if that's differently, if that's a different view than how you view it, but that's kind of my perspective on this.
Yeah,
I think that's talking, I'm going to share this grid.
Sure. So one of the things that I'm getting a lot of questions about as I'm in the branches and talking with clients is, well, let's say I do start to rotate into the more defensive sectors. Do I go for the big growth companies in those areas, or do I go for value? And I think, like Ben, like you articulated quite nicely, is generally speaking, if you're going defensive, you're looking for value. So you may want to cheat more towards the value companies in the defensive space, as opposed to, oh, I think this new company in the healthcare system is going to do really, really well, and so I'm going to jump into a growth. It could be an early opportunity, sure, but I think when we're looking at rotations, it's away from growth and into value, away from the growth sectors and into the more value-oriented sectors, Ben.
So let's do that. Let's take a look here really quickly, and I'm going to just drill down into one of these areas and say, okay, where might we see value relative or in relationship to growth? And so I'm going to come in here to the consumer defensive or the consumer the staples, what we typically refer to as consumer staples. So I'm going to open up this grid here and I'm going to maximize just that cell. So this is consumer staples, right? We start to say, all right, we see this move to the upside as the SPX has been moving down. We see the 50-period simple moving average turning higher. We've seen a little bit of a pullback into a support level. That support level drawn right around that. In this case, the numbers don't matter, but the levels matter in terms of that level of support in this group, this particular sector. So now, what do we say? Well, where is there some strength within consumer staples? Where would we find some strength in this kind of value area? So there are a lot of different ways to search for value. I mean, we've got a phenomenally prolific group of researchers and economists that talk about this on a regular basis. Our Schwab Center for Financial Research, Liz Ann Saunders, Kathy Jones, Jeffrey Kleintop, that talk about this idea of value and understanding some of the fundamental aspects and the macro aspects here. You and I think, will look a lot at some of these technicals in that context as well. But one of the things we can do is we can pop over here to the Market Watch tab and we can go to the Visualize sub tab. And we're looking at the S&P 500 as a broad whole this morning, but we can drill down with this tab into some of those areas. So here's consumer staples.
Oh, there
and
you
what
go.
do we see in terms of the strength in consumer staples? Well, we're seeing Walmart and Costco, which arguably straddle the line between discretionary and staples, because people have a choice about where they shop, and some of the things that they sell are discretionary, but things like Coca-Cola, Pepsi, Procter and Gamble, Clorox, Colgate, those are all some of those things that you have to buy, right, Jeffrey?
Yeah, absolutely. So as we're looking at this, what you could see is, and also keep in mind that size does matter. So big companies like a Walmart and a Costco can have an outstripped effect on what happens to a given sector, just like a given sector can have an outstripped effect on what happens to the overall economy, the S&P 500 in this case. But I've noticed too, Ben, there are some green pockets in here.
Oh,
When
yeah.
you see that brief little pullback in the staples, you've got a lot of companies that do have some upward momentum. So I really like this drill down experience, and that is figure out the story behind the headline. Read the article. Don't just look at the headline. So I think this is a really good call out, Ben.
Well, here's one thing that I just happened to notice. Take a look at where we're starting to see some strength today, and it is in the beverages space. Now, certainly there are some people that are enjoying their Coca-Cola and their Pepsi, but there's also some people that are enjoying their Coors and their Constellation adult beverages and their Brown and Forman as well, perhaps maybe even a little bit more so than their Coca-Cola and Pepsi. Perhaps makes sense on a start to a week like today. But here's the other thing. Mondelez is moving higher today to the tune of almost 2%. So maybe they're drowning their sorrows, perhaps, or nervous snacking on their Oreos this morning. But at the same time, we're starting to see things like ConAgra and Campbell's and Archer Daniels Midland in kind of the food production space picking up some steam as well here in this particular case. Janelle says, I love root beer. Me too. That's good stuff.
Yeah.
Hey, so Jeffrey, let's come back over here to the charts again really quick and kind of wrap this up, because I know that a lot of traders have been paying attention to things like the space, the technology and the chip sector space. So what I want to look at really quickly is this one, and this has some news today, and that's Taiwan Semiconductor. Taiwan Semiconductor seeing a little bit of volatility here, and you notice that I had already this level of support drawn in at this particular point, seeing perhaps a little bit of a break below that level. One last stock I want to look at really quick, and I know our time goes so fast, and that is AAPL, Apple, this morning with the down move on their postponement of their smart home hub and updating Siri at the moment.
Gotcha. Yeah, something to keep an eye on. I noticed that's probably lining up with that 230 zone of support as well for some traders out there. Yeah.
Exactly. I'll tell you what, Jeffrey, we are almost out of time, but I wanted to just quickly reiterate this. Listen, you can find more information at Schwab Coaching. Check out our webcast. Click on that subscribe button down there at the bottom of the page. You can follow me on X at Ben Watson CS. You can follow Connie on X. I think you're probably going to be there pretty soon, aren't you, Jeffrey, as well?
I really hope not. Gosh, they might talk me into it. They may volunteer me that I need to be on that, but for now, I'm doing everything I can to stay off social media. But I do love getting to watch the comments that you guys are putting out regularly.
Once again, thank you, Jeffrey, for being here with us. We certainly appreciate it, and we appreciate our great production staff and Connie Hill for helping out, and all of you for being with us, whether you're in the recorded version or the live version. And have a great day and a great week this week, and we will see you all very soon. A lot of great webcasts coming up. Jeff, thanks, and I will see you again out there on the road somewhere. We'll see you.
Thanks, Ben.
Bye-bye.